Very good evening to you all, friends. I'm Sanjeev Singhal, Chairman of the Auditing and Assurance Standard Board and Vice Chairman Committee for Member in Industry and Business. I'm the Central Council member in this 25th Council. I welcome you all to one more webinar of AASB in our series of the specialized webinar. Today we'll be talking about the key consideration in the audit of real estate sector. Friends, as we know that real estate sector has certain peculiarities. When Ind AS was not there, when accounts were prepared as well as audited on the basis of accounting standard, even then we have a guidance note on revenue recognition for real estate. And now when Ind AS 115 has come, normally there is a completed contract method unless the control is passed on over a period of time. So one has to see that when the control is passed, whether at a point in time or over a period of time. And that becomes the basis of revenue recognition. As an auditor, you have to be very careful as to when the revenue should have been recognized and when it has been recognized. Because this will be a very, very important amount in the whole P&L. It will also impact the balance sheet. There are other issues also in the real estate sector. For example, if only land has been acquired, can we say that the project has progressed to a particular percentage or not? Income tax computation and tax treatment at times is totally different from the accounting treatment. So there are various challenges that this real estate sector throws. To deal with these kind of challenges and the other challenges today, we have put up a team of 4 of our star chartered accountants, 2 as speaker, CA Mayank Chavla and CA Shiva Goyal, and 2 as moderator, CA Gautam from Ludhiana, CA Amit Bansal from Batinda. And let me tell you that Amit has a vast experience of working in the larger firms and he's dealing in Ind AS. He's specializing in Ind AS. So, despite being in a town which is not, where you will not find many practitioners on Ind AS, Amit Bhai practices only and only in Ind AS. Similarly, I met Shiva at Rohtak, again a very young and energetic professional, who is doing a traditional as well as a modern way of practicing. He has inspired many chartered accountants in his previous webinars also, seminars also, and I'm sure that this session will also be really inspiring. And of course, there is Mayank, who will be dealing with this subject along with Shiva. And then we have Gautam from Ludhiana will be moderating this session from Amit. And friends, as I've mentioned in the previous 2 webinars also, the AASB and the Committee for Member in Practice has recently approved an audit tool, which is made by a company which is run by a chartered accountant. And there are significant discounts that the institute has agreed along with this software. So, and this software is also available on a trial basis for some users and for a particular number of audit assignments. I would strongly encourage you that kindly have a look at it. And if you find it suitable, you can think of subscribing to it. But friends, please remember that audit documentation is very, very important. Without audit documentation, audit is not complete. So kindly think about it, that whether your documentation is complete or not. May I now hand over the floor to our 4 young, bright chartered accountants, starting with Gautam, to take this session forward. And once again, I would like to express my sincere thanks to all the 4 speakers and moderator, and Anil Lalji, Deputy Secretary of the Institute, who has been organizing these programs very, very meticulously. Thank you, and over to you, Gautam.
Hello everyone, CA Gautam this side, and today I would be moderating today's meeting along with CA Amit Bansalji. Firstly, I would like to express my gratitude towards our institute as well as CA Dr. Amit Singhalji, Chairman of ASB Board ICAI, and CA Vishal Dosiji, Vice Chairman of ASB Board ICAI, for organizing this session for our CA members. We have covered other topics in previous series of seminars organized by ASB, and today is our 118th CPE program organized by AASSB board, and today we will be discussing audit considerations in the real estate sector. The real estate sector is a rapidly growing industry offering significant opportunities for us esteemed CA members. However, it represents high risk of income concealment and tax evasion. Therefore, it is crucial for us to understand key factors involved in auditing this industry. Our guest speakers for today would be CA Mayank Chawla ji and CA Shiva Goyal ji. And if I talk about CA Mayank Chawla ji, he is a fellow member of the institute and he has qualified CA in 2016, securing the 40th rank across India. Additionally, he holds a bachelor's degree from Delhi University and a diploma in information systems audit from ICAI. He has 5 years of working experience in one of the big fours, where he has also served at the managerial positions. And he is currently a practicing chartered accountant. His expertise includes statutory audit, internal audit, providing virtual CFO services to corporate clients, uh, internal internal control implementation, and India's and IFRS implementation. He has served various manufacturing and service industries, including FMCG, information technology, real estate, sugar, and telecom. Furthermore, he has extensive working experience with corporate groups from diverse geographic locations, including UAE, UK, USA, Japan, and Germany. So I would like to invite CA Amit Bansalji to follow the conversation further.
Thank you, Gautam ji. First of all, good afternoon, all. I, C. Amit Bansal, welcome CA Dr. Sanjeev Singhal ji, Chairman ASB, and CA Vishal Doshi ji, Vice Chairman ASB. Welcome, sir. First of all, I shall like to thank sir for giving us the opportunity to attend and moderate such a knowledgeable webinar on key consideration in audit on real sector. This topic has been always close to my heart and it's really very interesting and knowledgeable. So I think so. Gautam ji has already shared a lot about the webinar. So now, not taking much of your time, I will like to share some words for our renowned speaker of the day, CA Shiva Goyal ji. Fellow Chartered Accountant Shiva Goyal is not just a practitioner, but a guiding light in the financial and auditing landscape based in Rohtak, Haryana. He's a fellow Chartered Accountant by profession and a highly acclaimed speaker on indirect taxation and standards on auditing, where he has shared his insights in over 100 sessions at esteemed forums, tax bars, associations, and ISCI branches nationwide, reflecting over 7 years of dedicated research and consultancy. Recognition of his excellence includes Rashtriya Gaurav Award, awarded by ex-Lok Speaker Sabha Mrs. Meena Kumar, and Young Entrepreneur Award, awarded by Indian Achiever Forum, acknowledging his exemplary contribution and achievements. He has co-authored a handbook on GST, impact on real estate sector, and has participated as a panelist in various MSME events that further exemplify his commitment to knowledge dissemination. He has been invited by ASB and committee of members in practice of ICI to deliberate session on different auditing standards and its practical implications for members while discharging professional assignments. Shiva Goyalji mastery in auditing is evident from his role as a keynote speaker at numerous ICA branches pan India, where he has delivered more than 50 sessions on the practical intricacies of standards on auditing. His academic credentials include PG DBA in Finance and Symbiosis, Pune, and various certifications and diploma in ISA and ICI and diploma in IFRS from ACCI UK. He is indeed a young and dynamic chartered accountant with his innovative approaches and profound insights, which underscores his unwavering dedication and commitment to excellence in the taxation and auditing domain across the nation. Now, not taking much of your time, I will invite CM Mayank ji for his deliberations. CM Mayank ji, please, over to you. Thank you.
Thank you so much, CMS Bansalji. First of all, before starting, I would like to thank Chairman Sir, ASB Board, for giving us this opportunity, for inviting us to share our experiences with the all the participants on today's topic. So today's topic is unique in itself because the kind of complexity that surrounds real estate sector uh, is something that can be seen in last 20-25 years. There have been a lot of litigations, a lot of undelivered projects, a lot of risk surrounding the real estate sector as a whole. So today's deliberation would cover the intricacies which may be involved while we as auditors are delivering audit services, and what are the things that should be taken care of while we are auditing a real estate entity. So while before I start my presentation, I would just like to share my screen. So I hope my screen is visible to all.
Yes, so it is visible.
Thank you so much, both of you. So before we move forward, let us just first have a basic idea of what real estate is. So real estate in general includes anything that is attached to land. So the land or anything attached to it tantamounts to real estate. So be it an agricultural land, industrial land, uh, you could say hospitals being built over the land, and residential projects, commercial projects, all this tantamount to real estate. And real estate plays a very important role, a critical role in our economy, because as we all know, a famous slogan which was given by Indira Gandhi ji in late 60s, roti kapda and makan, which is like makan is an important factor. It has been an important factor in all of our lives. Every individual aspires to have their own house, uh, and there are a lot of initiatives being taken by the government of India as well, in like Pradhan Mantri Awas Yojana and other initiatives which have been taken by the state governments as well, uh, just to make sure that people from each and every category of the country have access to their own house. So we can, in general, categorize the real estate in three parts. One is the residential real estate. As I told that, real estate, residential real estate would generally include uh, structures which are made for living purposes of individuals and families. Then there is commercial real estate, which would include hotels, retail shops, and malls. Nowadays, data warehousing centers and similar kind of commercial for similar kind of commercial activities. Then there are mixed use developments. So mixed use developments would generally include a residential housing society, which not only has residential units but also has commercial retail shops as well, commensurate with the residential part. So this is what we need to understand before we move forward, that what real estate in general is. So our presentation will be moving forward in this direction only. Now, just to give an idea of the real estate market, so we have a little bit of data which was published by CRIDAI when they released a report on building Viksit Bharat, transformative role of real estate sector in India. So as this graph here, currently the real estate market is somewhere around $300 billion, and the growth that is projected is around 16% in CAGR terms, which is immense when it is considered with the what the long-term GDP growth of the country is. And the same is expected to again further grow by 11% in the next 13 years. So by 2047, we are looking at 5,170 US billion dollars, which is remarkable in itself. And then when it comes to the percentage of contribution of real estate industry as compared to the GDP, it has been on a continuous rise. So it has gone on to be 7.3% as of 2024, expected to further grow to 13.8%, which is almost double in the next 10 years. And then again, it is expected to grow to 17.5% of the total GDP. So this graph is just a representative of what kind of opportunities might be there for our fellow colleagues as chartered accountants, because this sector is not only litigative, it requires a lot of assurance as well from the auditor's side, and this would always demand continuous professional upgradations from our side, and I think it is a good field to be in. So now let us understand, while we are talking about audit, we need to know what kind of audit should we generally accept. So while we know this real estate industry has a lot of litigation, there have been a history of non delivery of projects, and a lot of individuals and families have suffered because of those purposes. And that is not only relevant for the individuals who have suffered, that is also for uh, us auditors as well, to know whether when we are accepting an audit of a client, what kind of background they are having, which includes the background of the management of the company, whether there are any criminal cases against them, or any kind of business risk which may be there, because these things are relevant for us to conclude whether we will be able to reduce the audit risk to an acceptable low level or not. Then the organization structure and the qualification of the management also plays a very important role, because that makes the auditor understand what kind of environment that the company may have if the audit is accepted. Then the susceptibility to fraud is more in real estate as compared to some of the other industries. Reason being, there might be involvement of unaccounted money, and there are uh, a lot of facilitation payments involved at times, so which somewhere increases the fraud risk in this industry. Then this is more relevant for listed clients or real estate entities which may be planning for an IPO, or there might be certain uh, other pressures on the management which may also increase the risk to a higher degree. Now the one thing that we need to make sure as auditors is whether we will be able to reduce the audit risk involved when such kind of pressures are there on the management, because it will help us understand the overall risk involved with the acceptance of the audit. And then obviously for the continuing relationships, we will have to see what kind of experience we have had in the past with the same clients. So friends, the most important thing while accepting is to have an idea about the group and the background of the people who are associated with the group, because nowadays a lot of lenses are there on the auditors as well. We have NFRA, having a watch over us. It becomes very important for us to that we accept audits which will not bring disrepute to our profession, and also it will encourage good practices in the market and amongst the auditees as well. So I'll just move forward to my next slide, which is on understanding the entity and its environment. So SA 315, as we all know, requires an auditor to first understand the entity and its environment. So when we talk about environment, the entity's environment, it includes certain parameters, few of which have been listed here. One of the important parameters in real estate sector is applicable laws and regulations, because with the involvement of RERA and you know Stamp Act and a lot of different laws and regulations which are there in real estate, it is very important for us to at least have an understanding of what those laws require. And this topic will be covered by Shiva Goji in detail once I go through this particular slide. So other than that, we obviously need to know about the business risk involved, because the biggest business risk in this particular industry is the risk of failure of delivery, and which is generally led by the financial difficulties that real estate developers face because of the maybe because of the division of funds or escalations in the cost, delayed projects. These are the reasons that there are failures with the real estate developers, and these things are to be accounted for while we are evaluating the entity and its environment. Then ownership and governance structures become important, as we had already covered in our previous slide as well, that it is important to have a management who has knowledge of the industry and business. Prior knowledge is very important, and the kind of integrity the management has also plays a very important role. Then we have a financial reporting framework. So as Sanjeev sir also highlighted earlier, there were a lot of uh, ambiguity in terms of the revenue recognition itself. Then we had a guidance note in 2012, and now under the Ind-AS, the perspectives and the nuances of revenue recognition are completely different. So it is important for we as auditors to understand what kind of financial reporting framework is applicable on the entity, so that the procedures are generally aligned in that context. Then financing and investing activities are important, because what we have seen from our experience, generally real estate entities are formed in the way of special purpose vehicles, with one holding company having a lot of subsidiaries which are acting as SPVs, having an individual project in those companies, and there is a lot of rotation of funds through those entities. So to understand that that kind of investing activities are involved or not is important. And then, as we all know, it's a highly debt driven culture in real estate, and most of the companies have a lot of debt. So the expectations of the users and what kind of reportings are required to the lenders is also very important while we are understanding the entity and its environment. And then there are certain other industry specific matters. As I told, RERA is there, and there are certain peculiarities that we may have to understand before we can actually proceed with our audit. So I would just like to hand it over to CA Shiva Goyal ji, so that he can at least have a give us a brief understanding about what are the peculiarities regarding the real estate industry and the environment surrounding it. Over to you, Shivaji.
Thank you so much, Mengji. Before I start with, I would also like to thank AASB of ICI, including chairman, vice chairman, and all the team members of the AASB of ICI for giving me this opportunity to speak on the audit considerations in the real estate sector. And when we talk about a sector specific series, then it is very important for us that we move from general and go to the specific complexities and the regulations that are applicable only for that sector. Otherwise, in general, we will be doing auditing as per other laws also. So I would like to share my screen and would like to cover certain important points that are there in the real estate sector. I hope my screen is well visible. Yeah. So I would be skipping the real estate definition, but I would like to focus upon like real estate sector is very important from the viewpoint of GDP. It contributes to around 6 to 7% of the GDP of the country and gives assistance to various other sectors. For example, the banking financing that is done, it is around 21% of the total loans and advances by the banks were related to this sector only. And of course, other 250 ancillary industries, steel, paint, cement, bricks, building material, consumer durables, and so on and so forth. Lot of it's a labor intensive industry as well as capital intensive industry. So it's a huge. It affects huge industry. So real estate sector is very important. How it works is, for example, a builder is like building let's say 4 towers. Then either he can have a specific SPE, special purpose entity, for that particular project for building those 4 towers, or it can also be done in a consolidated manner. Or if like there are two buildings that have to be built upon, then builder may incorporate the two special purpose entity wherein the project will be executed. So it can be in the form of parent company, subsidiary company. It can be funded also. Then there are development through joint development agreements where there is a landowner and a builder, and there is a contract between landowner and builder. We will see in the later slides how the contract is worked. So only purchasing a land by a builder, then building a building, and then handing over to the client. But it has moved beyond that. It is moving towards the agreements which are monetary, then it has moved to non-monetary agreements, a kind of barter agreements, and then mixed agreements also. Then TDR in real estate sector is also one of the critical issue that needs to be dealt upon while doing the audit of a real estate company. So transfer of development rights. So basically, when we talk about TDR, then supposingly that development rights are that gives us the right that how many basically developable area, SRA model, then it is also one of the key consideration when we talk about the audit of the real estate company. See, we have lot of things to cover up on the real estate sector and the audit consideration, but keeping in view the time constraints, we will be able to touch upon the important points only, and I would rather be skipping the basic slides and keeping touching upon only the important aspect that are important from the audit perspective. So different terms that are being used in the real estate that are not being used anywhere is FSI. That's a FSI, floor space index. So if FSI is 2, then probably you can build up to 2 floors, for instance. In certain area, at certain states, the FSI can be different. It may vary from organization, like Huda gives a different FSI. It may give only a ground area to be built upon, or it can vary upon area to area, then it can vary upon organization to organization. Then TDR I already told, transfer development right. Occupancy certificate and the completion certificate is the key role in the real estate sector. Even in AS 115, when we talk about the that revenue recognition, then I think that CCOC also plays an important role. When to recognize the revenue, some of the developer might say that once we receive the substantial amount, and there is a CC obtained, there is a completion certificate obtained, only then will we be able to recognize the revenue, and they are probably going through the project completion method, not on the SPOM, which will be further deliberated in our further slides. But I'm just touching upon the terms that are being used in the different real estate regulations, maybe in RERA, in GST also. You will see that CCOC plays an important role. If the money is received after CCOC, then probably GST is not applicable. It comes under the category of Schedule 3. Yeah. So probably we need to see very diligently once our concepts are clear. See, and SA 300, we are planning an audit of financial statement. SA 315, we are understanding the entity in its environment. And believe my words, once you plan it well, half the battle is won. You're just 50% done. Your work is done. Because once we plan better, it's a very old story also. You have to plan how to sharpen your axe in a better way. Then you start cutting your tree. In the same way, in audit, I would rather go into the basic concepts. Whatever sector you are auditing, you have to plan it well. You have to understand the concepts and the different models and the complexities of that particular sector and the different terms being used. Only then would you be able to evaluate the true and fair view, or the measurement of the correctness of the accounting policies and estimates that have been used in preparation of the financial statement by the management. Then carpet area, built up area, super built up area have very, very relevance in the real estate sector. For instance, if I talk about in RERA, there is a one, whenever developer makes an agreement with the customer, then he charges in general according to the super built up area. May not be on the basis of carpet area. Carpet area is the area which you are getting. It's a living area, but super built up area may include an additional area, including the lift area or the balcony area or the area wherein you are not living, but probably the builder has set up certain amenities in that area. So builder would be charging on super built up area. But as per RERA Act, it is very essential and mandatory for a builder to write the carpet area. So for instance, you are doing the audit of inventory and there is unsold inventory. Then while doing auditing, there is a consideration as to see like which area has been used while measuring the inventory, whether it's a carpet area or a super built up area. See, it has to be as per the RERA Act, of course. You have to check the agreements. You have to see that what specific underlying documents are there that will reveal as an auditor to judge, to see what is the reliability on those inventory valuation, because it plays a very important role when we talk about the audit of a real estate company. In the end, at the end of the certain slide, I'll be taking you to the reporting requirement wherein I will show you the audited financial statements of DLF and auditor's report. So trust my word, when you read the auditor's report, you will have the clues and ways and means that what aspects as an auditor we need to cover in the real estate sector, how the valuation of inventory has been done, what is the policy regarding that, what is the policy that has been used to recognize the revenue, which is the major part. And Myangji would be covering it further. So on a fast basis, I just trying to set up certain technical terms which will be used in our further slides in a very fast mode. Apartment, of course, the RERA Act has defined certain definition of the apartment. Also, the same definitions are in the GST Act also. So GST has borrowed definitions from the RERA Act so as to maintain the integrity and the integration of the various acts applicable on one company. So, for example, if there are different acts and different terminologies and different definitions used in different acts, then it will be very difficult for the builder to adhere to the definitions. Then, of course, law has taken care of all these things, and perhaps these definitions are very, very much relevant from the RERA perspective. Then comes the affordable residential apartment perspective. So whenever you are auditing the affordable residential apartment, then you must know that what actually affordability in the residential apartment means. What are the specific limits? For example, in the GST, if the gross amount charged is not more than 45 lakhs, if it is beyond, it is below 45 lakhs, and combining with the area 60 square meter in the metropolitan city and 90 square meter in the non-metropolitan city, then taken into consideration both the conditions, it is considered as affordable residential apartment. Then project, what do you mean by project? It definition is given by RERA. So we are not touching upon the real estate laws here, but how to do the audit. Yeah, but I'm just giving a hook as to the terminologies given in the act are very, very exhaustive, and that should be used as it is. And you have to check the financial statement, you have to audit the financial statement basis the governing laws and regulations that are there in the RERA Act. So competent authority, everything is there. FSI I have already defined. Then there is a one standard on auditing which talks about the asset 250, I guess, wherein you understand the laws and regulations governing that industry. So while you understand, while you do the audit of real estate sector, the specific IGAP that was issued back in 2012, that is very important from the viewpoint where there is no mandatory requirement of following the Ind AS, because the company is not meeting certain threshold limit to follow the Ind AS. Of course, that will be referring to the IGAP, then RERA Act. There are different contracts between lender, builder, then builder, consumer. So Indian Contract Act is also very relevant at that point of time. Transfer of Property Act, then Registration Act, Indian Stamp Act, Income Tax Act per se, Goods and Services Tax, GST Act, post 2019, 1st April 2019, the new schemes have come into play where the ITC is restricted. So it is very important for auditor to know the applicable financial reporting framework, because in audit what we do, we check the financial statement are prepared in accordance with the applicable FRF. And what I am talking about here is the applicable financial reporting framework on the real estate sector, which is also mandated by SA 250. And it is also very important to document that we have checked these governing regulations that are impacting our company. So you have to document also, because it is always said that work not documented equals to work not done. So whenever there is a inquiry as stated by Myung, you will have to show the evidences in the form of working papers as a 230 audit documentation. But still, the lot of other laws, Companies Act gives a lot of restrictions on the loans and advances that can be accepted or that can be given by the real estate company to its subsidiary company. It should not exceed certain limits as specified under Companies Act. Maybe Section 185, 186 of the Companies Act 2013 comes into picture. Then Urban Land Acquisition Act, Rent Control Act, FDI guidelines, LODR. In case of listed companies, quarterly statements have to be issued. So the revenue recognition has to be in that way, as per Ind AS 115. So you have to take care of all the laws and regulations governing that industry. Then joint development agreement, I already told. There is a land with the landowner. Builder has a potential of building and the construction. Then landowner gives the land to the builder with the agreement that at the end of the constructed flats, certain flats will be handed over to the landowner. So it's a barter exchange system. Landowner is transferring the development rights of the land to builder, and builder in consideration is giving certain constructed flats to the landowner. It's a kind of joint development agreement that comes into play. So in JDAs, you need to be very, very peculiar in terms of auditing the real estate company, how the agreement has been drafted. Is it purely on the area sharing basis, or it has certain revenue sharing part? For instance, the landowner will be taking 20% of the total revenue or profits. It might be possible along with two flats, for instance. So it can be anything. So the agreements today at the times are so complex, then you must have a legal team in your team, or you obtain a legal confirmation, which is also mandated by one of the standard, that you obtain external confirmation while doing the audit. Then mixed shoring agreement comes into picture. Then there are certain housing society redevelopmental projects which a builder also do. For instance, there is a society, and the society buildings are totally demolished, and society trustees gives a contract to the builder to reconstruct it, and this is known as the housing society redevelopment. In consideration, there can be any contract between the society and the builder. They give certain constructed flats also. They can give certain extra area also, which is the additional area apartment that is available for sale. So it can be anything. Then rehabilitation, redevelopment, uh, slum rehabilitation projects are also there, that are one of the part of the developmental real estate companies. Then there are different terms being used in the P&L statement of the real estate companies, such as cancellation charges, penalties for the breach of contract, surrender of the tenancy charges, notice pay, because there is a sometimes builder do not adhere to the guidelines, or they are not able to complete the project within the timelines. So perhaps there are cancellation charges, or the agreement is cancelled, or there are certain litigations. Then how to handle those litigations and contingencies or the charges, how to account for as an auditor to see whether the accounting treatment has been done properly, is one of the special consideration to be considered by the auditor while doing the real estate audit of the real estate company. Then PLC, prime location charges, external development charges, club membership fees, deposits, maintenance charges are the certain terms which will be further deliberated by Mayank, that while doing the audit of each of these P&L item or the balance sheet item, what are the specific considerations that are supposed to be used by the auditor while doing the audit of this financial statements. So I have given a basic, the hook for the special considerations in the complexities while doing the audit of real estate company. I have talked about various terms, and then I have talked about the different acts that are governing the real estate sector. So right away, I would like to hand over to the my co-speaker, CM Yang Chavla ji, to please start the remaining deliberation on the special considerations while doing the auditing per se. Thank you.
Thank you so much, Shivaji, for your insights. Now that we understand what different terminologies are there in the real estate, various laws which are present over there, why it was necessary for us to understand it, because without a proper understanding of the entity's environment, we may not be able to proceed with an audit, and we may miss out on some of the important aspects, and it is very important for us to have a thorough understanding of the industry and the entity itself before we can actually proceed for an audit. So, friends, let us now delve into the audit procedures, or you could say the how we should proceed with our audit when it comes to audit of a real estate entity. So right now, my screen shows a slide which is for the purpose of competition of materiality. We all are aware that SA 320 covers the calculation of materiality. So materiality is generally calculated at a financial statement level. It may be calculated at a account balance, class of transaction, or disclosure level as well. If there are certain kind of risks which we may want to cater with a lesser materiality, then we have to determine a performance materiality, which will in turn determine our uh, extent of our procedures. And generally, what we have seen that in real estate industries, the performance materialities are generally kept lower, so that the nature, timing, and extent can be increased, because lower the PM, the greater is the extent of the procedures that an auditor has to do. Then we have certain benchmarks which may be used while computing the materiality, and the suggestive ranges of percentages which may be applied to the benchmark. So revenue is one of the criteria. So I mean, it depends what kind of entity we are auditing. If we are auditing an entity which has recently started development of a project, so we may not have revenue in the profit and loss, and we may have to move to certain other parameters. So revenue and PBT may be relevant for clients which uh, have been into this industry for a longer period of time and have consistent revenues and consistent profits. And for those who have just started the business, or who do not have that kind of consistency in their revenue and profit, they total assets or total equity might be a better criteria for determining the materiality. The percentages shared over here are only suggested, and obviously professional judgment needs to be applied by the auditor before that percentage can be applied with the selected benchmark. So once the materiality is computed, and then we move forward and we understand uh, about the internal controls which are surrounding the material account balances, class of transaction, and disclosures. So when we talk about controls, it involves whole plethora of things which uh, primarily include entity level controls. Why entity level controls are important? Because uh, we have to understand what kind of control environment the organization is having. With control environment, we mean what is the tolerance level of the management. So if management is very tolerant of fraudulent activities committed within the organizations, or maybe by the vendors or other stakeholders involved, then the susceptibility to fraud increases, and obviously it would in turn increase the audit risk as well. And if an entity has a good control environment, which somewhere emphasizes on compliance, and which emphasizes a good code of conduct, then it certainly impacts the audit risk as well. And then when it comes to the process level controls, we need to do proper walkthroughs of the key account balances and class of transactions, and need to understand what kind of controls are there, preventive, detective, compensatory, and all those kind of controls we need to evaluate before we can proceed. I mean, as we all know, right now, uh, reporting over internal controls is also mandatory for certain set of companies, and real estate being larger ones, generally it is applicable for them as well. So it is very important for us to consider the controls at the entity level and at the accounts balance, class of transaction level as well. So we will discuss about these material account balances, class of transaction and disclosures in our presentation today. These are in general very important for an auditor to cover while they are auditing, and there are certain peculiarities involved with these account balances and class of transactions. So we would be having a focus on these for our session today. So let me just move forward with revenue first. So I mean, any business is run for earning revenue, and this is the most important part because uh, most of the transactions in the organizations are done for earning this revenue. And it becomes even more important to understand revenue in real estate because there are a lot of judgments involved when it comes to revenue recognition. So, before Ind AS, we had a guidance note in IGAP, which we can see from in our slide as well, which was issued in 2012. Uh, Now we have Ind AS for the companies which have net worth of more than 250 crores. Then the basic difference between these two standards have been the main premise on the basis of which they have been drafted. So the premise of the IGAP has always been the risk and reward. I mean, this is a terminology that we have read uh, so often, and we have been using it for each and every industry before the Ind AS came into picture. But it is somewhat different from the definition given by Ind AS, which is of control. So when you say control, control is more judged from the perspective of the customer. When the benefit has been passed on to the customer, that is where control comes into play. So it is more of a customer centric standard when we talk about Ind AS 115. Whereas IGAP is more sort of supplier centric, where we are saying when the supplier has in turn transferred the risk and reward. So there is another term that we use in India, which is satisfaction of performance obligation. So the obligation is satisfied when you certainly transfer the control of any good or you have satisfied your services. Then only it is generally termed as satisfaction of a performance obligation. Now the timing of revenue recognition has been very litigative because income tax has its own stance. So today, income tax law mandates percentage of completion method through ICDS and through Section 43 CV. As far as bookkeeping goes, uh, the entities which are covered by the IGAP, they are mandated somewhere to follow guidance note, even from the department side as well. And when it comes to Ind AS, so it is a matter of a judgment for the companies to evaluate what kind of project they are into and when the control is being passed to the customer. So to give you an idea, generally the control is passed when the customer is able to consume these services over a period of time. So as far as real estate industry is concerned, when it comes to real estate, residential real estate per se, it is very difficult to consume the services without getting the possession of the property. So that's why it has caused a lot of controversy as well, whether it is mandating to follow completed contract method. But there have been certain guidelines or certain circumstances where revenue may be recognized earlier, provided the customer is able to simultaneously consume the services and take the benefit out of it. So control is generally said to be passed over a period of time if it happens. So what are the key considerations when we talk about the IGAP in India? So in IGAP, there has to be reasonable testing of estimated project revenue and the estimate project cost. So when it comes to percentage completion method, the percentage is calculated on the basis of estimated project cost. And so the denominator is the estimated project cost, and then at the numerator, you have the cost incurred in that date. And that percentage is applied to the revenue on the basis of which we understand how much revenue is to be recognized, and then we have proportionate cost being recognized as expense as well. So this involves a lot of judgment because the cost of the project keeps on changing with the market scenarios, with the commodity rates changing over a period of time. And since these are long-term projects, it may be very difficult for an auditor to actually evaluate whether the estimates of the management are right or not. And the same thing happens with the revenue as well, because unless until the revenues are controlled by the government, like in case of affordable, where state government, just like in Haryana, DTCP is controlling the selling prices of affordable houses. So if that is not the case, and if the sale values also keep on changing, then there are two variable parameters that we are playing with, and it becomes very difficult to actually evaluate what how much is total revenue is going to be and how much project cost can be estimated. Then we need there are certain criteria which are required to be fulfilled under IGAP before the revenue can be recognized. One of them is that 25% of or more of the construction cost has to be incurred. So why this criteria is there? Because there has to be right to payment with the builder. Right to payment is generally not substantiated in this industry just because there has been an agreement. Because generally agreements contains refund clauses because of the non-performance. Even RERA suggests if the same is not developed, if the project is not developed in time, then the developer is liable to refund to the customer. So when a developer completes 25% or more of the building, it gives certain assurance that the construction is progressive, and there is a high probability that the project will be delivered. So that's why this criteria has been given by guidance note, which was introduced in 2012. Then the other criteria is that 25% or more of the saleable project uh, has to be sold through an agreement. So when we say about agreement, it is like agreement to sell or the builder buyer agreement. Again, why 25%? Because if developer is not able to sell particular percentage of the project, it might not be able, the developer might not be able to complete the project, which requires funding through those customer receipts only. So if the customer receipts are not to a certain extent, it will be wrong to say that the revenue should be recognized. And then another condition is there at the agreement level, that for suppose we have 10 agreements with customers of 1 crore each, that is 10 crore in total. And let's suppose 8 of the agreements we have received more than 10 lakhs, and in 2 of the agreements we have only received 5 lakh rupees. So the revenue will be recognized only of those 8 agreements where we have received more than 10 lakhs, which is 10% of the total consideration, that is 1 crore. So because again 10 minimum 10% criteria has been given because it brings more certainty that the customer will in turn buy the property, and the same will not be refunded. So these are the some of the criteria which have been defined by the guidance note on real estate. So moving to Indies, it is a quite open field. As we all know, Indies have been prescribed or drafted uh, with a lot of judgment being involved, and it has been uh, you know the opportunity or the option has been given to the entity what they think is best, considering their business and the industry. So judgment is required to be exercised first of all, whether the revenue can be recognized over a period of time or at a particular point of time. As I told earlier, it is a difficult task for not only the entity but for the auditor as well, and thorough evaluation is required to understand what kind of obligations that a company or the builder has, on the basis of which only it will be decided whether the revenue has to be recognized over a period of time or at a particular point of time. Then there are barter transactions which have to be taken care of, as Shiva also covered. So there are certain agreements where landowner is transferring the land rights, and in turn the landowner receives the some of the constructed units. Now the service that is being rendered by the company is of construction service rather than I would say a real estate development service. And in turn the developer is receiving land holding rights and the development rights with it. So these transactions have to be grossed up in the PNL and presented at a fair value, which was not the case when it comes to IGAP because there is no specific guidance around it. Then in this industry there are certain refund liabilities because which may arise because of cancellation from the side of the customers or maybe defaults from the side of the developers as well. So while you are assessing the transaction price on the basis of which the uh, you know revenue will be recognized, the transaction price has to factor in the refund liabilities that may arise in future. So those have to be estimated at the time of recognition of revenue only. So this is what it is when it comes to IGAP and Ind AS. So we need to have a thorough understanding of what the financial reporting framework applicable to the developer, and then we need to have a thorough understanding of these standards and how we can apply it to that entity. Moving forward, I mean, let us understand what kind of audit procedures may be relevant while auditing revenue. So these are the 5 of the assertions that are generally checked upon when it comes to audit of revenue. One is completeness. So to ensure completeness, obviously there has to be an independent population from where the sales register can be reconciled. So allotment register may be the one. Then you can do certain analytical procedures where you can evaluate that on the basis of the total unit count and the average sale price, whether all those have been considered while estimating revenue or not. Then for the accuracy, it becomes very important to check the cost estimates. We may have to involve independent experts as well to understand the market scenarios. We may have to evaluate the reasonableness of the estimates, like you know, quantity per acre to be consumed for maybe steel, what kind of rates have been applied, whether they commensurate with the market rates currently which are there, and the inflation as well. So a lot of judgment is there, and that accuracy becomes very important, because on the basis of that accuracy only we will be able to recognize the revenue, because percentage of completion method involves a lot of judgment. Then if there are circumstances where some of the units are sold at a very low price as compared to the similar units sold to some of the customers. So this may indicate that one customer has paid unaccounted money, and that's why the less prices has been charged from him or her. And thus it is very important to check the documentation properly to ensure that those cases can be uh, dealt with, and we have the adequate documentation involved to uh, somewhere mitigate that risk. Then when it comes to occurrence, we have to vouching, and on a thorough basis, a test check basis, we need to uh, select the samples, and demand letters, tax invoices, the agreement to sales, and the collection from the banks should be traced, so that it gives an assurance that these are the genuine transactions they have occurred. So documentation is very key in this case. When it comes to cutoff, we need to make sure that the period is right when we record revenue. So what might happen that in some of the cases there are overdue balances of debtors, that debtors also not pay on time sometimes, because they are individuals and they might have their own financial difficulties. Generally there are time periods when grace periods are given to the debtors or the customers, and when uh, the money is not received in that much time, then the developer has a cancelable right. So it might have happened in at the financial year end, that those events might have occurred, and maybe a letter for cancellation may have been issued, a proposed cancellation, and cancellation might have happened after the year end. But since the conditions were prevailing as of 31st March, those revenues may not be recognized if they are cancelled subsequently before the signing of the financial statements. So these are some of the cases where cutoff has to be taken care of. Classification, then real estate is a very big industry, and it not only has sale of property. One might only engage into construction services. One can build a commercial complex and lease it out as well. So when you have multiple revenues flowing into your profit and loss, then it is very important to classify them properly. That is why classification becomes very important. And when it comes to India's, there are certain nuances in relation to the significant financing component which needs to be taken care of. because the transaction price on the basis of which revenue is being recognized should not have any significant financing component, and it should be at a fair value. So that has to be taken care of as well while we are recognizing revenue under the Ind AS regime. Moving forward from revenue, let's move to inventory, which is again very important topic. It is somewhat related to the revenue recognition as well. So what do we mean by inventory? So project inventory generally has three things. One is the cost of the land and the development rights, the stamp duty, the registration charges, and anything or everything which is related to the acquisition of land or the development rights of the land. Then we have capitalization of borrowing costs, because this is a long-term project. It generally qualifies the definition of qualifying asset, and the interest, which is specific interest on loans which are specifically obtained for the purpose of construction of a project, needs to be capitalized. And in case general borrowings are being utilized, their interest has to be proportionally capitalized as well. And there are then construction and development costs, which are the direct costs which are incurred for the purpose of the active development of the project. These are the only costs which can be capitalized. These includes approval costs as well, which may be like EDC charges are there, IDC charges are there in some of the cases. Then you have license fees being paid, and you have your steel, cement, all the material which is being used. Then there are electricity, plumbing charges, all that stuff which is part of the core construction has to be capitalized. But it is very important to understand there are certain expenses which should not be capitalized as well, such as head office expenses, anything which is being consumed by the uh, for the purpose of general administration, or the marketing expenses, the selling expenses. These are the expenses which should be directly charged to the P&L and should not be capitalized as part of the project inventory. Why this is relevant? Because if you inflate the project inventory, the percentage of revenue would again be higher, and it would in turn result in a higher revenue being recognized than it should have been recognized. So it can distort the true and fair view that is to be achieved while preparing the financials. So this classification becomes very important. What kind of procedures we can do for testing inventory? So again, these are the 5 assertions that we can delve into. One is existence. So one should physically visit a few of the projects and see what kind of progress is there. You may have to somewhat refer to the engineering certificates or the architecture certificates which are there, to just compare whatever being certified by them you can see physically or not. And then valuation becomes very important, because inventory valuation in these cases uh, may be very difficult, because the market values of the project as well as the cost keep on changing. And if there are indicators that a project may not be profitable, then we may have to reduce the carrying value to represent the inventory at a net realizable value or a fair value. Then rights and obligations needs to be verified. So title deeds have to be reviewed, because the deeds have to be in the name of the entity, and there should not be any title disputes. If there are disputes, then again the litigation part gets involved. And you need to have uh, you know understanding of whether there are any encumbrances over the land, any loans have been taken on the basis of encumbrance of a land, because ultimately that needs to be disclosed in the financial statements as well. For the completeness, we may have to again take a independent population, where we need to make sure that all the properties which are there in a particular project, uh, they have been classified and included as part of the inventory, and they have not been wrongly classified as maybe investment property or PPE, because that is a general dilemma for a management, whether whatever they're constructing would be classified as inventory, investment property, or PPE. So just to give an idea, anything which is held for sale has to be classified as inventory. Anything which is there for leasing purposes may be classified to investment property, and anything that they are creating for the self consumption, maybe the head office building that they have created for their own office, may have to be classified as property, plant and equipment. So all the inventories which are held for sale have to be recorded as part of the inventory. and the construction and development expenses which are in relation to current period has to be recognized and should not be deferred, and vice versa, the cutoff has to be made sure. Then classification in terms of the financial statements also becomes important. So as I already told you, inventory, investment property, and PPEs has to be appropriately classified, and we need to have the borrowing cost being capitalized as inventory rather than presented as a P&L item, which is directly in relation to a project, or proportionally capitalized on the basis of general borrowing capitalization rate. So moving forward, the next thing to cover is loans and advances. As I told earlier, this a lot of money is involved in real estate sectors. There is a lot of movement of money which is received from the customers. So what generally happens is when a project is launched, the developer can get certain proportion of the amount they had already paid for the land. That money gets refunded back to the developer. The intent of that is primarily to help them fund the construction, and in turn more money can be released from the RERA account. But what we have seen the practices, there is uh, churning of money by the real estate developers, where they, once they receive the money from the RERA account, it is generally transferred to other, to fund other lands, acquisition of other lands. And if that particular land is not licensable, or somewhat the deal is not able to go through, or if there are recoverability issues, then the current projects for which amounts were received get suffered. So that is why loans and advances has always been an area of concern for the real estate entities. Sometimes advances are given without proper timeline when the uh, you know a land acquisition deal is going to close, or how, when the money is going to come back. So those kind of intricacies are there. Documentation is a big problem, because a lot of times these movements are between related parties, and the documentation level between the related parties is not as robust as it is there with the third party. So that is also a problem to look upon. Then advances, as I told you, advances are generally given as a diversion of fund as well. So the intent has to be, we need to evaluate the intent of the company while they are giving those advances, because that will help us understand whether we'll be able to reduce the audit risk to a certain low level or not. Now, what kind of procedures we can do? Balance confirmation is very important when it comes to existence, because these are transaction in money, and balance confirmations are the only things that would substantiate in addition to the loan agreements or the approvals. For completeness, we may have to see the board minutes, whether all the transactions which are represented in the financial statements, they commensurate with the board minutes or not. So what generally happens is some of the transactions are not disclosed by the company which have settled during the year. So for suppose if we take a loan of 100, we give a loan of 100 rupees and we have received it back during the year only, those loans are generally not disclosed, or maybe since the ledger has zero balance, they are uh, taken off from the trial balance entirely. So we have to be thorough when we check board meetings. We may see certain approval for certain transactions which has happened, and then there is a register of loans which is required to be maintained by the companies as well, from where we can check whether certain loans are given which may not have been disclosed by the entity. Valuation again, so impairment indicators may be there. So impairment indicator means there might be circumstances where loan may not be recoverable. So certain a holding company may give certain advances to their SPV for the purpose of acquisition of land, or maybe for the purpose of construction. If anyhow the project gets halted, then we need to evaluate if that advance would be recoverable as is, or there might be any devaluation or impairment required. Then experts may be involved if we have to, if those advances have been given for acquisition of further land, and whether the land for which that advance has been given, or over which a right has been created, we would be able to, the company would be able to realize it at that value or not. So the rights and obligations, the loan agreements need to be reviewed. I mean, the legal rights have to be confirmed, because in case of uh, part, if the agreements are not there, then the recoverability would be more challengeable in the code of law. And there may be certain securities being taken as well against the loans given. So whether mortgage deeds have been signed and whether those have been updated with the MCA records or not, these things are also to be evaluated. When it comes to classification, what we have observed is certain payments are adjusted against loan, which are meant to be against the interest due. So that in turn, you know, uh, has an impact over the loan balances, and loan balances may be not appropriately valued because of the wrong adjustments. Then loans and advances which are in the nature of transaction in money and advances which have been given for against land have to be appropriately classified in the financial statements as well and needs to be presented separately. So now we delve into related party transactions, and generally when we understand about the structure of a real estate group, so it is very complex. A lot of related parties are there, and the movement of money is huge. So it is always a key risk area in a real estate entity to understand the related party transactions and how they might impact their audit. So these are some of the related party transactions which are seen in a real estate entity. Investment in the subsidiaries is the common transaction because generally the projects take place in a particular SPV, and investment is being made by the holding company to the subsidiary, and then subsidiary purchases the land, and and then further construction is being done. So there might be impairment indicators if the particular investment which is done in a subsidiary does not turn out to be successful. Then similar thing can happen for loans and advances because money may be given in the form of investment or may be given in the form of loans and advances as well. Then the third point, corporate guarantee. Well, this has been a very prevalent topic, or you could say a famous topic in last 1 or 2 years, because there have been certain changes in the GST as well, which uh, implies that GST has to be payable even though no corporate guarantee charges have been recovered by a holding company or from their group companies. So that has to be taken care of, and also India requires accounting for these corporate guarantees at fair value, considering them as deemed equity investments. Then management and service fees for common infrastructure. So what generally happens is real estate entities have a common brand name. They generally have a common head office, and most of the operations are managed from there. They have certain key managerial personnel who are working for all those projects, and appropriate allocation of these costs is really important, because it has to be seen from the taxation laws point of view as well. And even when you are following India, then it becomes important to record the transactions at arm's length. Now, what can be done while we are auditing the related party transactions? Confirmations are the key, because we need to confirm the closing balances. The agreements and the documentation has to be thoroughly checked, because these are the areas where documentation is generally inadequate. For the completeness, review the board meetings and the audit committee meeting minutes, the shareholder meeting minutes. Uh, these transactions have to be approved, and then we may reconcile with you know the list of related parties which have been reported by the directors in the MVP1 register of agreements, which are there with the related parties, and we can reconcile with the trial balance or the books of accounts whether the transactions have taken place with them and those have been disclosed to the auditor or not. Valuation, as we have already discussed, there may be impairment indicators, and they may not be recoverable, which has to be estimated on the basis of the progress of the project that is being managed by the particular SPV. And fair valuation may also be required for certain non-arm's length transactions such as corporate guarantee, the brand fee, the interest-free borrowings which are given. So fair valuation may be required in these cases. For the rights and obligations, legal agreements have to be there. We need to make sure that even if it's a related party, it has to be backed by proper legal agreements. And in case certain investments have been pledged by the holding company to, obtain the borrowings, we may have to be very vigilant about it and inspect the documents, and the same has to be disclosed properly in the financials as well. Presentation and disclosure, a lot of disclosures have been defined by SEBI LODR. Then there are Companies Act disclosures as well. Accounting standards define the disclosures in relation to the related party transactions. And then if the guarantees have been given on behalf of the group companies, then it has to be disclosed as contingent liability as well. So this has to be taken care of. So moving forward to the next part, property, plant and equipment. So when it comes to PPE, these are the key focus areas that we may look at. One, we have already discussed differentiation between PPE, inventory, and investment property. Then there may be inconsistent capitalization policies, like one item may be capitalized in one project, and in another project it may be transferred to inventory. So, for instance, generally there are expenses incurred such as labor hutment charges. So hutments are prepared for the temporary labor which is there. Now, some of the builders capitalize it to the property, plant, and equipment, and some transfer to the P&L, to the inventory. So ideally, the capitalization has to be PPE and not the inventory, because they are not to be handed over as part of the project and should be depreciated in the period of construction of the project. Similar things may happen with other items as well. So a judgment may be exercised and policy has to be defined by the group, which has to be consistently followed by the other group companies as well, which are in turn going to get consolidated with the holding company. So it is important to have consistent policies. Impairment, again, when it comes to real estate, impairment is a major issue, whether it is of investment, loans and advances, property, plant and equipment. If the indicators are there, then it has to be tested. Disclosure regarding encumbrances. So adequate disclosure needs to be made if there are encumbrances over the PPE, because it is very relevant for the users to understand what kind of encumbrances there may be against the PPE held by the entity. And even the lenders are very keen at this information, and it is required as per the applicable FRF as well. So moving to the audit procedures, again, on-site visit is very important, as we have discussed with the inventory as well, because the condition of the PPE, which has been already recorded in the financial statements, may not be as desired. There might be certain obsolescences as well, which can be confirmed only if we visit the site. Then third-party confirmations may be required for financial leases. Then for the completeness, we may have to reconcile the fixed asset register with the general ledger or the trial balance, because completeness of the FAR needs to be ensured. And we need to obtain a list of long-term PP projects, and we need to understand what the status is, how they are progressing, and whether it is a time for their capitalization or not, because the company may be delaying the capitalization, because ultimately, if you capitalize, you will have depreciation impact as well, which will in turn reduce the profits. So this may have to be checked if there are long-term PP projects. Valuation, again, depreciation needs to be checked for the arithmetical accuracy standpoint. Then supporting documents may be checked whether the assets have been capitalized at the right value or not, because it has to include all the incidental expenses which are there for the acquisition of the property, plant and equipment. For rights and obligation, again, if it is a land, the title deeds, the agreements, it becomes very important. And for the presentation and disclosure, extensive disclosures have been defined by the accounting standards, and it is important to disclose the encumbrances, depreciation methods, and the impairment. All these things are required to be disclosed properly. And the misclassification, again, is a very key focus area between the PP inventory and investment property. So now moving on to the admin, selling, and marketing expense. This has been a major part in real estate, because real estate generally involves extensive marketing, and huge amount of brokerages are given to the brokers, and radio marketing. I mean, huge costs are incurred. What generally happens is, it is very difficult in case of services to identify whether the expenses are fairly recorded, because you can't tangibly recognize the services which have been received, and there may be lack of delivery evidences, which makes it very difficult to understand whether those expenses have been inflated or they are genuine in nature. Then expenses may be recorded in a wrong accounting period, uh, which we have seen a lot in case of brokerages. Generally the payments are made in a staggered way, and it may relate to a certain obligation which has already happened. Like in case of residential projects, generally the brokerages are in the form of whatever number of applications. So, for example, brokerages are payable 30,000 rupees per application received. So it does not have a criteria of guaranteed allotment. And if the project has been launched at the end of the financial year, nearby February or March, it may happen that the invoices from the brokers are received in the next accounting period. But since project was launched and all the applications were received before March, uh, the provisions have to be booked. Then there might be inappropriate capitalization of admin, selling, marketing expenses as project inventory, which we have already discussed, that only the direct expenses are capitalizable, and it would distort the revenue and the direct expenses presented in the financial statements. Some of the cases we have noticed that expenses in relation to one project are booked in different projects. The intent may be to you know book expenses in projects which have high profitability, to maintain a particular level of profitability in a project, to substantiate solid balance sheet, or maybe to avoid taxes as well. So it has to be taken care of that that these expenses are booked in the project and are substantiated by service delivery evidence to the extent possible. Now, coming to the audit procedures, again, I have tried to jot it down at the assertion level so that it is easier for the audience to understand. So for the occurrence, the delivery evidence is the key. I mean, there has to be an evidence of delivery of goods and services. The agreements have to be there, and the original invoices, and the evidence of payment. All these things are necessary to substantiate the occurrence of a transaction. Completeness, you may scrutinize the expense ledgers uh, post the financial year end, uh, and may find expenses which should have been recorded in the previous period but have been transferred to the next period, which in turn affects the profit and loss. Then accuracy has to be verified from the supporting documents, whether the correct amount has been recorded or not. Analytical procedures may be done, like budget versus actual, which is very important in this industry, because budgets are set before the actual expenses are incurred, and on the basis of that, one may evaluate whether the expenses have been recorded appropriately or not. Then cut off the year-end expenses needs to be verified. I already gave an example in the form of the brokerage. The accruals and prepayments have to be calculated accurately. So there might be expenses which are of prepaid nature. So that classification has to be appropriately done as prepaid and not to be transferred to the P&L. So classification is important because it has to be as per the applicable FRF, the financial reporting framework. It has to be classified appropriately, all the expenses, and those have to be taken care of while we are vouching for the expenses that the account had selected is right. So friends, now I would just like to throw some light upon other key areas which are important for the industry. One is the litigation, because a lot of litigations are involved due to non-delivery of project to the customers, or maybe payment concerns, so issues with RERA, and there are other litigations for the land title and with the income tax or the indirect tax departments. So this real estate industry is full of litigations, and the ambiguity is ever so rising, and it is very important to involve experts so that you can understand the possibilities of future liabilities, to report it appropriately as contingent liability, or if any kind of provisions are required to be taken in the financial statements. Then going concern issue may also be there, because when the projects are stalled, it becomes very difficult to justify the going concern assumption. So it has to be keenly seen in this industry that whether going concern is there or not, and certain indicators may be default in the loan repayments, escalation of cost, and these things pose a significant or material uncertainty over the going concern assumption. Deferred tax, I mean, somewhat to an extent related to going concern as well. If the going concern gets impacted, the deferred tax is also there to be seen, because if the tax losses are there, it has to be seen whether it will be recovered in a prescribed time frame by the Income Tax Act or not. And judgment is generally required, because this is about future events, when and how the profits are going to come. So it is very important to have proper documentation, how these judgments have been evaluated, and how these deferred tax assets have been recognized. Friends, I will end my presentation over here, and I would like to hand it over to Shiva Goyalji now. So I have tried to cover all the important aspects which are to be seen while we are auditing the real estate industry. There are certain aspects in relation to the reporting that may uh, play a very important role, which would be covered by Shiva Goyalji. So Shivaji, I would like to request you to take it over from here.
Yes, please. Thank you. Thank you, Myang ji. I would really appreciate that you have covered the audit part and keeping in a chart form that really, that would really help the members to, discharge their auditing duties whenever they are doing the client audit of a real estate client. So I would like to share my screen, and then would be continuing with the left out part, the reporting and the special considerations per se. So we had left over here that there are certain special considerations that auditors should look into while we're doing the real estate. Some of the points have already been covered by the Mayank ji. I would not touch upon those points, but the points which are really very important from the viewpoint of the special audit consideration, I would be only touching upon that point. So IGAP India's that has already been touched upon by Mayank ji. Then transactions of non-monetary consideration in JDA require a special consideration from the viewpoint whenever there is no value, then India's probably is guiding us for the fair valuation. Then you have to see that whether as an auditor, the management has actually taken a fair value considering the same kind of project being undertaken by in the same locality by another developer. So you might take a taste of that value, might take a opinion or a view and look and feel of that agreement basically to ascertain whether the valuation has been done correctly or not. There are a lot of schemes also, such as subvention schemes, where the developers are coming with the point that the customer, you just pay 20% as of now, and the remaining 80% will be paid by the customer upon the completion of the contract of the project. So there could be 30, 70, or 10, 90, it can be anything. But you have to see that whenever an advance is received by the developer, then it should be presented as an advance from a customer rather than reducing from the the trade receivables or the trade payables, it require a proper disclosure. Then multiple elements or the separate performance obligations should be given special consideration in terms of like if there are any club facilities being given by the real estate developer, then whether it's a part of inventory or it's a separate facility being given, that needs to be seen, because in case there is some facility that is not a part of that project in the ordinary course of business, then if we take into consideration the trade parallel, then club facility is a separate facility that should not be added to the inventory part. Of course, the treatment of the inventory vis-a-vis PP or investment property would, of course, be different, as also outlined by the Mengji. Then large set of related party transactions, as say 550 has to be considered, wherein related party transaction has to be talked about, and whatever disclosures, whatever Companies Act says, whatever different regulations says, it has to be on an arm's length price. So it has to be seen very minutely by the auditor, because the different entities are there, the different loans and advances are given, the promoter group companies might also be there. It could be in the form of partnership firms which are not subject to audit. So intentionally, the promoter, the real estate owner, may come up with a complex structure where the funds diversion, or where the amount of the transaction that is happening is not as per arm's length price or as per real estate related party transaction. So this way we need to be very focused, and every now and then auditor is being insisted upon to check all these transactions very minutely. Yeah, and sample size also has to be taken. In addition to the normal, it has to be more. Sample size has to be more. So please, auditors or the members, I'm requesting that to check this related party, to audit this related party transactions, and to understand the complex structure, how the transaction is moving. You may have to go certain. You may have to deep dive in to check the authenticity of the transaction, and to check whether the transaction is at appropriate arm's length price or not. Then we will come to the inventory valuation. We have to categorize into three categories. So at certain point of time, the raw material is not shown properly. It is mixed with the work in progress. So work in progress, management have certain estimates and valuations that management may deploy to value the inventory, specifically in the work in progress part. So you need to see the work in progress part, whether the raw material part as such being included in that, to you maybe inflate the value inventory part, or to maybe inflate the profits for that financial year. So you have to be vigilant in that particular scenario. Then impairment testing and project considered qualifying set has already been talked about. Then large projects, if I'm talking about the large project, then I'm talking of the, let's say, 10 towers being built up, or the full city, for example, or Mex city, or the any such cities being developed. Then part of land parcel is very high, and it has to be developed and allocated, and maybe project wise, because in RERA also, when we are developing such a city or a big building, then developer may come up with a point that we will keep these 10 towers will register with RERA as a one project, or with these 10 towers another project, or it may be vice versa, like they make group 5 towers into one project. So it totally lies within the purview of the management, how it identifies and allocates the project part in the large projects. So whatever it does in the RERA, you need to disclose, and you need to check in the returns filed or the disclosures made in the RERA Act. And books of account should also map cost to the related project. For instance, that for example, tower A, the cost is being incurred to the tower A, but in the books of account it is being allocated to the tower B. So you have to be very conscious that management may, or the company may deploy such practices, accounting practices, so as to inflate the revenue, or to inflate the cost as per the different purposes of the management to, just to have the bank borrowings to increase the CC limits or maybe the project funding. So management may get into these kind of things which require analysis into the Excel sheets. Like there should be a benchmark of the auditor. He should also he should have a proper knowledge of the thumb rule that this particular cost is the benchmark, for example, is the thumb rule. And if the cost is coming maybe 50% more than that, then we need to be extend our substantive procedures, keeping in view that particular compliance procedure taken in place. Then TDS on the sale of project is another something that should be reconciled by the auditor. It's very simple thing, but of course that can give you a very eye-opening view. For example, you know very well that whenever a payment is done by the customer, TDS has to be deducted by the customer and it will be reflected in the 26 years of the supplier. So while you are matching the advances received from the customers, you should probably check from the 26 years also. A reconciliation should be made. Whatever is being disclosed in the books of account as the advances part, and vis-a-vis what is being reflected in the 26 years. There may be certain non-reconciliations. There could be various reasons that the customer has not deducted the TDS, but advance is being reflected. So that part should be known to the auditor. Then TDS might have directed no deposit to the government by the customer. That also might be looked into by the auditor. Then there could be any reason that there are the differences coming out of that. There is one, for example, the advance received from a joint venture of a related party of a real estate company, but that has been parked to the advances received from the customer. So that entry will not be reflecting into the 26 years. Perhaps that you can look upon the difference, that why this entry is there, and you can further investigate and communicate with the TCWG or the management that as to why the difference is there. So in today's world, in the Excel and keeping in with the chat GPT in place, you need to run certain macros, certain filters, and the special special filters or the special macros, visual basics, and you have to run the large volume of the transaction. You have to handle the large volume of transactions, and you need to match the transaction with the 26 AS or the RERA returns. So auditor today must be very much technology savvy in order to check the large number of transactions. Then interest-free loan, in case the certain loans or advances to the related parties are being deployed, then it has to be seen accordingly. Then non-chargeable corporate guarantee implications are the main things for I would rather say one point here, that GST in the case of corporate guarantee, when it is being given by the parent company to a subsidiary or vice versa by the subsidiary company to the parent company, then the GST is being charged on the 1% deeming value or the actual consideration, whichever is higher, and 18% GST is being levied on that particular part. So you see that this particular thing is very, very important from the viewpoint that whether the company has discharged such GST liability in case the holding company has given corporate guarantee while the subsidiary company has accepted certain loans, and certain loans have been sanctioned for the subsidiary company. So that accounting treatment vis-a-vis GST treatment has to be taken into together, has to be seen taken together, and then auditor has to make a view while giving the final opinion as per SS 700 series. Then leasing model, selling model are there. In terms of leasing model, auditor has to see that whether the rentals are should be a part of it's a part of the income from house property, or it should be income from business income. Yeah. So in certain cases, you may see if the real estate developer is in ordinary course of business, is leasing that part, leasing the property, then of course it should be shown in the business income. But perhaps it may not be in the ordinary course, then that part would be triggered in the income tax as a house property per se. So tax treatment of the leases assets has to be seen accordingly. I have talked about the business income. Then segment reporting is a very important part. SA 501 comes into play where it talks about the specific considerations have to be given while doing the audit. For instance, that customer litigation, then it comes to the segment reporting. These from the viewpoint of SA 501, where SA says that auditor, you give a special consideration to these three things: provisions and contingencies, then to the segment reporting or the estimates being accounting estimates that are being used in the financial statements. Then you see here that impairment I've talked about. I will talk about this particular point, the routing of funds through this. You may please, yeah, routing of funds through partnership firm. So what nowadays practice is being going on by the real estate developer, that they are routing fund through the partnership firm. So what are they doing is they are making a partnership firm which is not being subjected to audit, because in the if it's a company, then start audit has to be mandatorily done by the start auditor. It's a mandatory requirement. But in case of partnership firm, there is no such requirement of the start audit until and unless there is a tax audit turnover limit that is breaching. So you have to see that whenever there is a partnership firm which is unaudited, then auditor has to give proper disclosures in the other matter paragraph as per SA 7.5, 7.6, sorry, 7.6, which talks about the EUM para and the other matter paragraph, which talks about that the company has a large advances being deployed from the partnership firm, which has not been audited by us, and the profit is also being routed from there to the real estate company, which is also unaudited. So we need to just mention that in our auditor report, so that our skin is safe to the extent that we have not audited the partnership firm, and the profits are of course tax free, but of course that firm has been tax audited, has been done by the another auditor. Then at certain point of time, this substantial amount of money is collected by the real estate developer. For instance, the 80% of the amount has been received, and OC is also received for more than a year. Sale agreement is also registered, but still rest of the money is not coming into the bank account of the developer, and revenue is not being recognized that way. So auditor need to recognize, inquire and make further deep dive into why the revenue is not being recognized even after the OC has been received, and it has been a 1 year. You might be knowing that in after a certain like 2 years point of time in income tax, there is a dimming fiction that if there is a lapse of period after a certain period, then income tax will be levied irrespective of the revenue recognition. Then there are certain titles of land that has to be seen properly by the auditor. Then we must have a basic understanding of the RERA Act and of course the land titles. In certain area there are like Lal Dora Jami land are there. Then in certain point of time there are land which are agriculture land. Then in certain point of time the land which is coming into the purview of the Nagar Nigam or the urban land, I would say. So for instance, that way we have to check the titles also. If the titles of the land is not disputed, at certain point of time there is a mutation that comes into picture. So auditor must have basic understanding of these terms in terms of like mutation or the certain loan if has been taken by the by the real estate company, then that should be updated in the mutation, or that should be a registered mortgage. Nowadays the registered mortgage is a very key prominent thing, that is key prominent regulation that is being coming. So previously there was no registered mortgage. Nowadays, different states have different registration charges for registering that mortgage. It may vary 1% also in Haryana. It is in Delhi, sorry. Then different states have different charges. You need to see very consciously that what are the different land titles and different loans taken in consideration of that. Then advances from the customer should be met with sale register. Then disclosure of valuation of the investment property has to be properly seen. One point I would take up for the RERA that is very important. Yes. This in RERA, very well that there is a designated bank account and there is a 70-30 rule. 70% that money is being collected from the customer, that has to be 70% of the amount has to be deployed towards specified project itself, and 30% can be used for the general business purposes. So whenever 70% money has to be withdrawn by the developer and funds have to be utilized, so CA certificate comes into play. As you all know that Form 3 and Form 5 are the very important forms in RERA. For instance, Form 3 comes into play when there is a certification by an independent CA, independent chartered accountant other than a statutory auditor. Whenever he certifies that, only then a real estate developer would be able to withdraw the funds. On the other hand, Form 5 has to be certified by the stat auditor. It's kind of an annual certification that is being done by the stat auditor. Within 6 months, it has to be certified. Both the forms serve a purpose to the auditor. It has to be synchronized. If, for example, Form 3 has been issued 10 times or 12 times in a year, then taken together, sum total of that Form 3 should match with Form 5, which is being certified by the stat auditor. So Form 3 necessarily to be certified by the audit by a CA other than the stat auditor, but Form 5 has to be by the stat auditor. So the different synchronization has to be done, and there has to be reconciliation and concurrence between different documentation. Then details available on the real estate returns has to be verified by the auditor. It's a very important point because quarterly returns have to be filed by the developer in the state-wise that's differ, but that is within the purview of the Central Act itself. Different returns have to be filed by the developer in regards with the different detail, how much units are sold, unsold, what are the area that have been sold, what are the area that is unsold, how many square feet has been carpet area, super built up area. All things have to be deliberated and elaborated in the returns itself. So the returns serve as a very crucial input for the auditor to check the as on 31st March whether these things coincide with the RERA returns, what has been shown in the books of accounts. At the same point of time, auditor should also should also check the CARO reports also, where it says that whatever in stock statement you are submitting to the bank, whether the stock has been declared in the books of account or not. It is in the same way that whether price variation, unsold inventory we are submitting to the RERA, that all things should all assertions or the balances or the P&L item should be verified in the books of account as well. That has been that has been given to the regulator. So that is very, very important per se. Then this 3CA 3CB also plays an important role if partnership firm tax audit is to be deployed. Then rule 11 is very important in terms of reporting the main audit report. Then CARO had a very, very lot of changes just few years before, where the quarterly returns that have been filed with the bank have to be disclosed there, and auditor has to make a remark there that whether the quarterly statement or the returns that have been filed with the bank coincide with the books of account or not, specifically with the current assets, stock, debtors, up to 90 days. In certain cases, it is up to 180 days if it is given in the sanction letter, but normally it is 90 days. So that is beyond 90 days are not considered for calculation of drawing power, as we all know. Then creditors also have to be seen while deduction. Sometimes 75%, 25% margin has to be seen in total, or sometimes it has to be seen debtors plus stock, then 75% has to be done, then credit has to. So there may be a different formula for that, that you have to refer the different sanction letter by the bank. So bank borrowing is also very important assertion, I would say, when you're doing the audit of real estate sector. So it's a huge amounts, and they are taking there is an increase in expenditure and the cost estimates. Then perhaps the borrowings are also increasing. Real estate developer is applying for increase in working capital limits. Yeah, so they are submitting the that cost is increasing. So we are we should get the increased limits so as to deploy the funds. So you need to see as per standard on auditing, also as per Caro report also, that auditor must check, keeping in with the larger broader perspective, and should have a knowledge of all the regulations in place for the real estate companies. Then identification of key audit matters. As you all know, standard on auditing 701 is the very newly introduced standard that talks about the key audit matter paragraph. I will just show you the draft audit report of a DLF real estate company, wherein I will show you what are the key audit matter that auditor may consider while doing the while drafting the audit report of a company. Then SA 250 I have already talked about. It's a very important essay. Then no clar, it's very relevant for the listed company. It's a non compliance of the laws and regulations. It has to be considered by the auditor in case the company has not complied with the laws and regulations in place. Then NAFRA has also described the certain limit that it will be considered as fraud if it is done by the officer or employee of the company, more than 1 crore amount involved. So GST I'm not covering. GST it is not a GST session, but still GST is relevant to the extent we are auditing, to the point that we should see the GST implications also. For example, as you all know, 1%, 5% rate is there, affordable 1%, non-affordable 5%. That too without ITC. ITC is restricted. That is mandatory restricted in case of residential apartments, affordable also, non-affordable also. So you have to check that whether that ITC is restricted, whether we have paid 1%, 5%, whether the management has paid that 1%, 5% to the government. Then in certain cases, in certain notifications, reverse charge mechanism has also been made mandatory. In certain cases, 80% of the material has to be purchased from the registered person only. In case it is not meeting the 80% criteria, then the differential has to be paid through reverse charge mechanism. So working capital will be blocked there. In case of cement, there is a different rule. So in real estate, there is a different things coming up. Corporate guarantee I've already talked about. Then in RERA, TDR is also under reverse charge mechanism. If landowner is transferring development rights to the promoter, then promoter has to pay a reverse charge on the this TDR. And on construction services, the real estate developer will be paying the GST in the forward charge mechanism, and you can use the ITC that is being paid on the TDR. So it is like that. So different rules and regulations and mechanism are there. I am just closing this slide, and only for another 2-3 minutes I am going to show the one of the annual report, auditor's report of the DLF. It will take another 2-3 minutes, and then I will be taking signing off from this session for further queries. So let me just share the screen. As you all can see this, it's a DLF audit report or the annual report. I will just go to the auditor's report. So you can see that to the members, it is an independent auditor's report to the members of DLF Limited report on the audit of standalone Ind AS financial statement. So we would follow. I'm not talking about the reporting paras, but I would only touch upon the focus part where you need to give the main parts to the reporting standards. Then EOM paragraph is very important. Here in the DLF auditors have emphasized one matter in a complaint against the company, that is for the unfair conditions. The CCI, Competition Commission of India, has imposed a penalty of 63,000 lakhs on the company, which is upheld by the appellate tribunal. Company has filed an appeal further with the Honorable Supreme Court of India, and Supreme Court of India, Honorable Apex Court, have directed the company to deposit 63,000 lakhs as per the directions. So it is a very important matter that it is a special complaint that is pending before the Apex Court. So correspondingly and simultaneously, different High Court orders where there is a large amount involved, there is a challenge before the High Court, then it can be further put into the this emphasis of meta paragraph EOM as per SS 706. Then key audit meta paragraph, which I was referring to in my previous slide, is the matters which are most significant in the auditor's report. For example, revenue recognition for the real estate project in the auditor's opinion, it is one of the very key audit matter, because company may have taken into consideration various factors, as Mayank ji has talked about. So our audit procedures, but we have done the audit procedure that should be elaborated here. We have read the company's policy for the Ind AS. We have obtained and understood the revenue recognition process. We have obtained the legal opinion also. We have test checked certain underlying consumer contracts also. What audit procedures we have performed, we have to document that. We have to write it also in the auditor's report. As per SR 230 also it mandates. And 701 talks about this. Claims litigation. That's a very sensitive part, as Mayank has also told about that. So that can be shown in the key audit matter paragraph. Advances paid for the land procurement, then impairment of the assets. It's very important that why the investments are being impaired. What is the specific reason of that? You need to assess the company's valuation methodology, and you need to obtain and read the valuation report. You need to consider the independence, make inquiries with the management to understand the key drivers, then defer tax. So like this, you can put forward the key audit matter paragraph, including the related party transaction, which is also which is also governed by SA 570. Then information other than standalone financial statement, we do not express an opinion on that, but probably we should include in our auditor report, and we should also mention this thing that chairman messages director report, once auditor report is drafted, it comes into existence after that. But if there is, we should read that as an auditor. If there is a material inconsistency in that auditor's report vis-a-vis the director's report or other things, then we should take a view and communicate the matter to the TCWG as per SA 260 and 265. So then management responsibility, auditor responsibility, then other matter paragraph. So see, I talked about the partnership firm audit. So here auditor has also mentioned here that we did not do the audit of financial statement in respect of one of the partnership firm whose financial statement include the company share of profit of 336 lakhs. So it is mentioning here that the company's profit include this kind of profit which is coming from the partnership firm, which are unaudited, and certain important things which are important from the viewpoint of as an auditor, that can be mentioned in the other matter paragraph. You can also make a mention there. Then report on other legal and regulatory requirement has to be mentioned as per section 143(3) of the Act, and we have report on that particular point. Then our sign would come, and auditor report and excerpts would follow. So I think given in time constraints and keeping in view the real estate sector and the applicable laws, I think 10 sessions would be maybe sufficient for covering, but we have tried to cover the touch upon the various special audit considerations as given responsibility to us by the AASB of ICI. Thank you, Chairman Sir, Secretary Sir, the whole team for giving us chance to share our very limited experience and limited knowledge with the learned members. It is indeed a pleasure, although we have crossed the time constraints, but of course the query session now would be followed. So again, thank you so much for patient hearing. Over to you to the organizers for further question answer session. Thank you.
Thank you so much, Shivaji and Mayankji, for the wonderful deliberation. Both of you have justified with the both of your presentation and covered all the aspects relating to the real estate sector audit consideration. Under the technical glitch, we have received few questions. So I request Amit ji and Gautam ji to please raise the queries received from the members. So Gautam ji, over to you, and Amit ji, over to you, please. Gautam ji, please.
Okay, so this is a question from one of our participants. Like, can we ignore the percentage completion method and follow project completion method in view of the legal decisions as well? Like, kindly show the light in it.
Mayank, are you there?
Yeah, I just wanted to confirm if it is being asked from me. Okay.
Yes.
So the thing is, the financial reporting framework is has to be followed. So that is not a choice with us. So as far as IGAP is concerned, income tax does not. I mean, as far as IGAP or India is concerned, income tax is very sure that we have to follow percentage of completion method in both the cases. The decision can be taken for the bookkeeping only, and it is quite clear with the guidance note that percentage of completion method is suggested under the IGAP. When it comes to Ind AS, yes, completed contract method has been more prevalent because it is again from the side of from the point of view of the customer, because the transfer of control is very important. But as far as IGAP is concerned, it may not be possible to justify using a completed contract method. And as far as income tax is concerned, as I told you earlier, it is mandating percentage completion, so that cannot be avoided.
Okay. I would like to invite CA Amit Bansalji for the question.
First of all, in the chat, I have received Shivaji and Mayankji a lot of appreciation that the deliberations have been really good, and the topic was beautifully explained within a short span of 2 hours. As Shivaji told that it almost is 10 sessions are also less for explaining this a big topic. So that's okay. But just the main two queries, although there are small queries, which are a lot of them, but I will take major two queries. One query is relating that Shivaji, it was being asked that like in the partnership firm which was being added like in the last few minutes back only, it was being said that the unaudited partnership balance sheet was incorporated into the system. So does it relieve the auditor about the liability of the being incorporating that balance sheet and just specifying that the unaudited balance sheet has been incorporated? First query is this one, please.
So, as an auditor, we have to see that what is the component in my balance sheet of the real estate developer for whom I have been appointed as an auditor. So I would rather say that if a particular amount is coming from another firm, partnership firm, for which I have not been appointed as an auditor and I have not audited that financial statements, so how can I means auditor is not required to audit that financial statement in order to certify that this balance is correct. No, the auditor will be relieved from its responsibility thereby in the other matter paragraph, thereby that this particular component or the profit share is coming from that partnership firm, and that firm has not been audited by us as an auditor. It may be a misconception to the stakeholders that if anything and everything that is being included in the real estate company's balance sheet is being audited by us. So by mentioning that particular thing, the dilemma in the mind of the stakeholders is removed. That auditor is responsible to the extent of certain assertions and balances that are lying in the ODT company, not beyond that.
Okay. Okay. Thanks, Shivaji. And another thing is one query is relating to the GST for the real estate. So the query is that like if it is possible for you to share some input related details, how much input we can take or some document can be shared with us over the emails. So that would be very grateful. Because GST has been explained, but they have told that like it is quite less. So if it's possible over the period, we can go ahead for that, sir. But it was beautifully explained within 10 minutes that GST how we can take. But if some summarize summary can be provided by you over the speech, and if afterwards any document can be shared, that would be great for us.
So I've written a handbook on the GST on real estate sector. I would
Okay.
of course be sharing that. I am in the process of amending that handbook, and I will
Okay.
be completing it in a while. I have prepared a very crisp matters
Okay.
which are there in the GST. For example, like ITC is restricted in the residential, then you cannot take any ITC. It is fully restricted. But in the commercial, the ITC is available. In the same way, there is a various representations that have been received from Nardeco. It's a very top real estate association in Maharashtra. They people are saying that 45 limit in affordable is nothing in the city like Bombay. We don't get anything. So every time there is a 5% GST coming out, and that is of course increasing the cost to the ultimate consumer. See, there are two costs. IT is being restricted, that is again being added to the cost, whereas the cement is 28%, bricks 18% or certain material. So it is adding high cost for the buyer to buy affordable house. Yeah. At
Yeah.
the same time, 1% and 5% of course would be borne by the ultimate consumer. Then there is the double burden, So there are various issues coming up in the GST in real estate. But what is prevalent today is the notifications free by 2019 till 7 or 8 by 2019, after 1st April 2019. That is a new era for the real estate. Even then the real estate sector is facing a lot of problems, keeping in
Okay.
view of that. Certain time of supply has been shifted. So even GST on real estate sector, AASB would not allow me to deliberate on that way. But
Yeah.
briefly, I have touched upon the areas which are very peculiar in terms of GST. But of course, I will share my handouts and the presentations with the members, but not today, tomorrow.
No problem.
But
No problem.
give me a week time, I would be sharing.
No problem, no problem. And another thing is like we are waiting for the Safari Retreats judgment to just come because that is a great thing for the real estate sector, I believe. Thank you, Shivaji, for beautifully answering these queries, and thank you, Mayankji, for such a beautiful presentation of yours. So
Thank you,
nice of you.
Amit.
And now I will hand over the mic to Gautamji for the further deliberations for the further proceedings. Thank you so much.
Okay. So there's another question from one of the participants to CM Mayank Chawla ji. So it is a practical question, like can you hold a pen and paper? Like it is assessing following percentage completion method and income recognized during different years are as follows. Like for first year, 25% completion and say 10 CR. Then third year, 25% completion, say 10 CR.
I just missed the second year. So first year it was 25%.
Third year was 25% 10 CR.
Okay. What about the second year?
Second, it is completing like it is moving on the 2 years gap.
But certain amount of completion would be done in the second year as well. Na? You can't just jump from first year to the third year.
But
Uh,
the
Gautam, what I suggest, sorry for the interruption. Like,
Right, right.
if there is a detailed query, then it would
It can
be,
be
it
mailed,
can
right?
be one to
We will
one.
Mailed.
Yeah.
Right.
okay.
mail the query to the speakers, then we will
Right.
revert the answer to the concerned member.
Right. That would be
Okay.
really better.
Yes,
Okay.
yes. Any other query, Gautamji?
Yes, I do have one query from
Yeah,
both of
please,
the guest speakers.
please,
Like,
please.
as you have said, like there are many laws applicable on real estate sector. So, as a CA, so how you gonna know all the laws which are applicable? Like, it is practically impossible to like just go through every law.
Right. So I would just emphasize that if we read our standards, I mean, SA 250 says there are laws which would directly impact my financial reporting, and there would be laws which are just supporting laws. So which I need an understanding of, but they may not have a direct impact. So we as auditors are required to have a thorough understanding of the laws that impact directly. So I would say GST, income tax, even RERA in this case has a direct implication over the real estate. So these becomes very important laws for us as the auditors. As far as certain other laws are concerned, for example, Stamp Act, Contract Act, so these are peculiar transaction level laws. Again, basic level understanding is required. But if something is not affecting my financial statements directly, I may only have a basic understanding of it. But if any law has a direct impact over any of the account balance, class of transaction, or disclosure, then we need to have a thorough understanding of that.
Thank you so much, Mayank Chawla ji. So I would like to invite CA Anil D. Lalji for further going, for concluding
Gautam
the
ji. Thank you, Gautam.
meeting.
Thank you, Gautam, for wonderful deliberation. I extend my heartiest thanks towards both the learned speaker, Mayank ji and
Thank you so
Shivaji,
much, sir.
for their wonderful deliberation. They have covered all the auditing aspects relating to this real estate sector. As we all are aware that we have covered all the almost many sectors relating to this auditing aspects. On 25th of this month at 4 p.m. we are again organizing one webinar on key consideration in audit of IT sector. I request all the members to please join for the IT sector related queries and audit consideration on 25th of this month at 4 p.m. So on behalf of AASB of ICI, once again, I extend my sincere thanks to both the learned speaker, Mayank ji and Shivaji. I also extend my heartiest thanks towards both the moderators of today's webinar. They have wonderfully moderated, C. Amit ji and C. A. Gautam ji, for their valuable participation and their precious time to moderate this webinar. I also extend heartiest thanks towards all the participants. So thank you so much on behalf of AASB of ICI. Good evening.
Thank you so
Namaste.
much.
Thank
Thank
you
you.
so much.
Thank,
Thank you.
thank you. Good
Thank you.
evening. Thank you.
Thank you,
So
sir. Thank you.